Welcome to the Deep Dive. Today we're jumping into something pretty big from a name you definitely know, Robinhood.
That's right.
They made this announcement back on July 1st, 2025. And it's not just some minor update.
No, not at all. It feels like a fundamental shift, a strategic pivot, really.
Could redefine modern finance, potentially.
That's the scale we're talking about, but it's definitely a two-sided coin. On one hand, you've got this bold, audacious innovation.
The pushing boundaries.
Exactly. But on the other hand, well, it kicked up a lot of controversy almost immediately.
Right. So our mission today, cut through that noise, look at what Robinhood's actually doing, these big moves.
And unpack that backlash, figure out what's driving it.
So for you listening, the real question we're tackling in this deep dive is, how do you tell what's genuinely groundbreaking here?
From what might be, genuinely risky, it's getting harder to sort out.
Okay, so let's unpack it. Robinhood, famous for, well, democratizing investing.
Bringing trading to the masses.
Right. Now they're talking about becoming an infrastructure builder for modern finance.
Yeah.
That sounds like way more than just a brokerage app.
Oh, it's a massive leap. The way Johan Kerbrat from Robinhood Crypto put it, they envision traditional and on-chain finance to seamlessly converge.
Okay, what does that mean in practice?
It means they want to bring the core financial machinery inside Robinhood. They call it internalizing the stack.
Reducing reliance on outside companies.
Exactly. Fewer third-party dependencies. They want to own more of the whole financial ecosystem end to end.
And they rolled out some specific things to back this up.
They did. Big announcements. For European users, first off, tokenized U.S. equities and ETFs.
Like stocks you can trade on a blockchain.
Sort of synthetic versions. Over 200 assets, they said, including, and this is wild, private companies like SpaceX and OpenAI.
Oh, okay. Private company shares. How?
Well, tokenized versions, tradable on Arbitrum, that's a layer 2 blockchain, makes things faster and cheaper. They were offering near 245 trading hours, even dividend rights pass through.
And Arbitrum is pretty established in the crypto space.
Right, a leading platform. But the even bigger piece, maybe, is Robinhood building its own layer 2 blockchain.
Okay, so not just using existing ones, but building their own custom version.
Yeah. Think of it as their specialized network. It's designed to handle everything. Issuing assets, trading them, settling trades, lending, staking.
Taking on the roles of clearinghouses, exchanges.
Essentially, yes,
Yeah.
integrating all those functions. Plus, they added crypto futures in the EU with 3x leverage.
Ooh, leverage always adds spice.
And ETH and SOL staking for both US and EU customers. So a whole suite of new capabilities.
And the initial reaction from the market, was it positive? Seemed pretty forward-thinking.
Overwhelmingly positive at first blush. Lots of buzz, lots of excitement about this future vision.
There's always but.
Here's where it gets really interesting. The backlash started almost immediately, in the absolute center of the storm.
Let me guess. OpenAI.
Bingo. The tokenized OpenAI equity. OpenAI came out very quickly, very publicly, and denied authorizing anything like that. No approval for secondary trading of their private shares, period.
Ouch. That's not good.
Yeah.
Even if Robinhood used third-party issuers for these tokens.
Right, which they did. But Robinhood listed them, displayed them on their platform. That implies some level of vetting.
You'd think so. It raises immediate questions about their due diligence, and for a brand built on trust.
Absolutely. The legal and ethical alarms went off everywhere. First, consent and intellectual property. You can't just slap a major company's name on a synthetic product without permission.
Feels kind of sketchy.
Then there's misleading representation. Are retail investors clear they're buying a synthetic token, not actual OpenAI shares? That line can get blurry fast.
Especially with dividend rights mentioned. Makes it feel more like ownership.
Precisely. And that bumps right into securities law. Depending on the jurisdiction, these tokens could easily be viewed as unregistered securities or maybe unauthorized ETFs. Very gray legal territory.
Which brings us to that shadow market critique I saw floating around.
Yeah, one fintech policy analyst nailed it, I thought. Called it regulatory arbitrage disguised as access.
Meaning using loopholes to offer things you maybe couldn't offer through traditional channels.
That's the implication, operating in those gray zones to offer products that skirt the usual rules, creating this sort of opaque, less regulated market.
How did the crypto community react? Usually they like pushing boundaries.
It was divided, actually. Some cheered the innovation, the 24/7 access. Others were worried it erodes trust if you don't clearly distinguish synthetic exposure from real equity. Creates confusion.
And regulators. I assume European regulators are looking closely.
You can bet on it. Intense scrutiny is expected. Like we said, a firm trying to build mainstream trust just cannot afford missteps that suggest they were, well, lax with their homework.
So, stepping back, what does all this signal for the future? For finance, for your investments? Robinhood is clearly betting big on this programmable infrastructure.
Yeah, the big strategic bet here is that the future competitive advantage, the next moat, as some analysts say, isn't just the user interface, it's the underlying plumbing. It's controlling the infrastructure layer.
Owning the issuance, the collateral management, the clearing, all in real time.
Exactly. That layer 2 blockchain they're building, it could potentially collapse multiple different revenue streams. Think exchange fees, custody spreads, staking yield into one integrated flow that Robinhood controls directly.
That's powerful. Which leads to a critical question for you, the listener. What do users prioritize more? Is it the 245 liquidity, the fancy programmable ownership features?
Or is it knowing the issuer actually consented and that the regulatory situation is crystal clear? It's a trade-off.
And if users do prioritize the access and features?
Then this could really start to chip away at what going public even means. Robinhood wouldn't just be competing with Schwab or Fidelity anymore.
They'd be competing with the underlying protocols, like Ethereum or Solana, or other layer 2s.
Potentially, yes. Competing at that fundamental infrastructure level. Positioning themselves as part of the next financial system's core.
But that's a whole new ballgame, risk-wise, for Robinhood too, right?
Oh, absolutely. Now they face risks like complex protocol design bugs, navigating this patchwork of global regulations across multiple jurisdictions.
And just keeping the lights on.
Yeah.
Infrastructure uptime becomes absolutely critical. A glitch isn't just an app bug. It could halt markets they control.
Precisely. Huge operational burden.
So summing up, Robinhood's dive into this full-stack finances, it's profound. It's complex.
Definitely. It really highlights that constant tension between wanting to innovate super fast, push the boundaries.
And running up against existing rules, regulations, and ethical considerations.
Mm.
It's a really bold gamble they're taking.
And it leaves a really crucial challenge for you, the listener. In this world where new financial products can pop up almost overnight, where markets shift incredibly fast.
It puts more responsibility on you.
It really does. You are increasingly the one who has to figure out, okay, what's real here, what's risky, and how do I navigate this safely?
Makes you think much harder about transparency, about due diligence, before making any investment decision.
Absolutely. It's a whole new level of scrutiny needed from everyone involved.